Hello, I'm Sandy Weaver with Weaver Financial. Let's do the numbers. In a nutshell, in the third quarter, bonds had a good return, U.S. stocks came in with an excellent return, and overseas stocks delivered an outstanding return. The drama and headlines continued in the third quarter, but AI, artificial intelligence, is still spurring optimism. Corporate earnings and interest rates remain in robust states. Tariffs are just starting to impact, but the front end buying in the first half of 25 has muted most effects to date. We'll see more. At quarter end, U.S. large company stocks roared ahead, returning 14% for the year. Small companies held their own, up 10%. International stocks, perceived to be less frothy than the U.S. and aided by a weaker dollar, returned at 26% year to date. Even bonds, our steady corner, gave us 6%. Let's start with tariffs and politics, the U.S. economy, corporate earnings, interest rates, overseas, and end with current market valuations and what's likely ahead. I'm not sure we have more certainty on tariffs yet, but they're being implemented as we speak. Challenges to those tariffs are making their way through the courts. Some are being thrown out, some are allowed through. Everything is being appealed. Who's suing? Everybody. Small businesses, organizations, institutions, the Trump administration. New tariffs seem to be announced weekly, perhaps as a plan B if some initial tariffs are denied via the courts. Businesses are caught in a mess, unable to plan. Many are eating the tariffs now by forcing some concessions in their supply chains and cutting margins. Most businesses compare the price of an input in the U.S., if it's available, to the price of that input from overseas with the respective tariff that applies. Businesses will not squeeze their own margins for long before price increases are quietly passed through to consumers. Inflation remains elevated, closer to 3% versus the 2% target. It will take several quarters before stability returns. Remember when businesses stocked up on inventory in the first quarter, resulting in a negative GDP contraction of minus 0.5%? GDP, gross domestic production, came in at 3.8% for the second quarter, offsetting much of that. Estimates for the third quarter range from 2.7% to a 3.8% by the Atlanta Fed's GDP Now tool. The Federal Reserve is projecting a 2025 total GDP of 1.6%, slower than 2024's 2.8%. Consumer spending is projected to remain high at 3% for the third quarter. Many economists report that the top-end, high-income consumer is responsible. Job growth has slowed way down from earlier in 25. The Bureau of Labor Statistics says only 29,000 jobs per month were created in the 3 months ending August. It's being termed a period of no hire, no fire. Unemployment remains low at 4.3%. Our economy is handling the drama pretty well so far. Corporate earnings continue to be a solid. Earnings grew 13% in the first quarter, came in at 12% in the second quarter, and are estimated at 9% growth for third quarter per Schwab's Pro Liz Ann Saunders. The US dollar still remains down about 9% this year against other currencies. The Federal Reserve cut interest rates on the short end in September. 1 or 2 more cuts are anticipated this year. The current government shutdown severely restricts the data they have to work with. Pros are mixed on if the Fed will stand pat on rates. The Federal Reserve's mission is stable prices and full employment. Political pressure from the Trump administration, a la the attempted firing of a Federal Reserve board member, is high to lower rates regardless. War continues in Ukraine, Russia, but is perhaps calming in Israel, Gaza. The conflicts continue to impact markets, defense companies, oil companies. OPEC has raised production, so oil prices per barrel remained in the mid-60s for West Texas and Brent during the quarter. China's economic growth is still quite healthy, now at 4.8%. Trade talks with the U.S. struggle on. rare earths for semiconductor chips. Their GDP of 20 trillion is less than the US's 30 trillion, but they've grown 74% over the last decade, while our growth has been 28%. They are a stiff competitor adversary. Where do we go from here? Some pros are concerned about the sky-high valuations in the US stock market among large caps. Price-earnings ratio, usually within a 12 to 22 times range historically for the S&P 500 companies, are now 25 times. That's the price you pay for $1 of earnings. There are two ways to cure that. Higher earnings will lower that PE ratio, or a market pullback will drop stock prices. Yet PE ratios can remain high for years. Ratios have moved even higher than this. Many pros are preaching diversification and safe corners to shield from what they perceive as frothiness in the markets. Pros point out that the latest deals in the AI, artificial intelligence space, are now using debt rather than internal cash flow. Leverage increases debt. Some deals now involve AI companies investing in other AI companies, investing in other AI companies, a dangerous round of musical chairs with billions of dollars. Email me if you'd like Morgan Stanley's chart and Barron's article on it. We've added diversification and higher quality in the portfolios this year and last, in both the bond and the stock allocations. We know the US economy is slowing some. We don't know how much AI, artificial intelligence, will counter that trend. Thank you for your interest. Please call or email if you want to dig in further. I'm glad to pass on my readings, podcasts, and other sources.